We were just looking at a look back at 2015, and we begin a new year very much the way we ended it. Global growth worries have defined markets around the world. These worries have underpinned a massive market meltdown in 2016 for the global market, with that slowdown in China unraveling expectations and certainly global equity values. Stocks in the U.S., for one, beginning the year with the worst performance of any year. Chinese markets right now near bear market territory, and European stocks currently at multi-year lows. Of course, the story of oil, one of the major issues here. Oil prices cut in half over the last year, and while many people say this is going to be a catalyst for good times, so far it has been an indicator of what's wrong with the global story. The shadow cast from China hanging over the United States with fears of a recession in the U.S. coming this year. Only time will tell how this plays out, but we have assembled a first-class panel for you this morning to talk about it. Gentlemen, thank you very much for joining us. We are joined right now by Paul Singer, founder, chief executive officer, and co-chief investment officer, Elliott Management. Martin Sorrell is CEO of WPP. And then we have Zhu Min, Deputy Managing Director, International Monetary Fund, and also joining the panel this morning, Ken Rogoff, Professor of Economics at Harvard University. Carlos Ghosn sends his apologies. He is en route from Zurich as we speak. Thanks very much for being here, gentlemen. Paul, let me kick this off with you. Do you agree with the assessment that was just made in terms of what's behind this market meltdown? How do you see the state of the world today?
I think one of the key elements to be thinking about global markets and the strange initial reaction is that for 7 years the world has been, the developed world directly and the rest of the world indirectly, has been existing on a diet of complete reliance, virtually complete reliance on central banks and central bank action. Really a continuation of the emergency action after the global financial crisis, during and after the global financial crisis, to hold up the global economy. What I mean is 0% interest rates, morphing in some places into negative interest rates, quantitative easing, which I believe is the effective equivalent of money printing, has had a support, of course, of the global economy, but B, has given presidents, prime ministers, congresses, parliaments sort of cover to basically do nothing in the way of structural reform. So the developed world has been growing very slowly over the last 7 years. There isn't much room for error, and I think it's been a very distorted policy mix. The prices, obviously, of stocks and bonds are distorted by what amounts to date to $15 or so trillion of central bank bond buying and stock buying also. But also the distortion is in that the best part of the global economy is how investors are doing, how financiers are doing, how upper income people are doing. And the middle class has been not participating. And so after 7 years, to get to the answer to your question, right, after some context, there may be a transition of the way investors feel about the central banks as in terms of complete confidence.
I'm glad you mentioned the central banks. That's really a critical part of this story. And in this panel this morning, we're talking about future shocks, how to navigate through them, and whether or not this is a lot steeper than anyone expected. And by the way, in about 20 minutes, I do want to open it up to all of you. We've got some really so many smart, global-minded people in the audience, and certainly we want to hear what you have to add to the conversation as well. Min, you wanted to jump in.
Yeah, I heard you use the words meltdown. I sort of tend to disagree. I understand that I'm taking huge risk at the beginning to disagree with the moderator. So I expect some unexpected consequence for my disagreements.
So you're disagreeing on the assessment of what's behind this meltdown that we've seen in global markets?
No, the first issue is I don't think a market melted down.
Okay.
The market in the process adjustments. Because if you see interest rates is on upside, the growth did not pick up follow the interest rates on the up, the market valuation have to be adjusted, right?
Yeah, good point.
Yeah,
we have lost $2 trillion in market value in 2.5 weeks. That's why I called it meltdown.
When market adjusts with all these uncertain volatilities, it can be overshooted, but it's not a market meltdown. I would say in the next 12 months, if you see the interest continue on the upside, if the growth not pick up as strong as interest pick up indicated,
why
was the
meltdown delayed? Why didn't it happen immediately after the Fed?
It's a great question. Yeah, what took the market so long to figure out that the economy was a lot weaker than people expected?
Well, when the Fed raised the rates, you have a very good point, because Fed did the good communication. People understand.
We didn't have the real shakedown until after the new year. So was that driven by concern also about China?
China was a part of that, but I think the more important is at the end of the year, people see more growth story. Mm-hmm. Because the valuation is very much driven by growth.
Before you started to drop your GDP forecast.
Yeah. But I think the
I don't think IMF played the key role here, okay? We do forecast, but we do reflect the global situation. I think that's a very important thing. So I think we should continue to have this idea in mind. We will continue the market will adjust forward.
We should point out that the IMF has cut global growth expectations how many times in the last 6 months? Twice?
No, that's very true because we see the growth getting slower and slower.
Okay.
But 2 points is very important. Number one, we still have a growth. 3.4% is
but not
growth.
Enough.
3.4% for the globe.
Yeah, for the globe, yeah.
Okay.
I think we still have a growth. I think that's very important. We're not below 2%. I think it's absolutely important number.
Right.
And number two, on the growth side, we also did a study. We say in the next 5 years, the potential growth is not the growth is getting down gradually. The potential growth also getting down.
So longer term, you're looking at growth coming down and down and down.
Exactly.
Yeah.
So
now,
that's important, have important implication for the market. We probably will see more market adjustments for.
More on this market adjustment. But Ken, you have been a bear on China for a long time.
Yeah, I don't think there's any question that what set off the most recent events and even the last half year has been concern about China. It doesn't mean that China's definitely growing slower, but it's sort of been the myth in the market that China could never, have a business cycle, that it was just a constant, a perpetual growth machine. And I think that nervousness has kicked in. Now, coming to Paul's point, it isn't so much that the Fed hiking the interest rate microscopically is what's driven this. What's driving it is the central banks are not coming to the rescue. People have been saying, when there's a recession, the Fed typically cuts interest rates 4 or 5%, and the European Central Bank maybe 3%. Well, there's no room to do that here. So I again stick my neck out a little bit, but I think the next year is going to see a lot of risk in emerging markets, and in China, Russia and Brazil are already having recessions. I think the United States and Europe, you can have a recession in any year, but I wouldn't say it's incredibly elevated at the moment.
I don't think it's a question of the Fed not coming to the rescue or central banks not coming to the rescue. I think, in effect, they've been part of the problem by enabling the complete lack of structural and fiscal reforms. I believe the developed and the developing world is capable of, and therefore I disagree that the long-term growth rate of the world is trending down. It has been, but it doesn't have to be. And what I mean is that a better mix of policies, tax, regulatory, education, training, retraining. Let's just talk for a moment about technological destruction. Everyone knows and everyone sees in 2015's markets that technological destruction in some industries has accelerated. The retailing industry, where we've known that clicks were going to replace going to the store, but all of a sudden in 2015, important parts of the top line have been removed by just a couple of internet companies. I think the world could do a much better job of being more flexible in a rapid response when their industries or become uncompetitive, either because of global competitive pressure,
I really think it's much
because of technological destruction.
It's much more complex than that, I think. And this is macro stuff, and so let's look at it from the firm level, the micro level. I think we underestimate the impact of that weekend in September 2008.
The weekend that Lehman went under.
Yeah, the impact on consumers. Why has the oil price fall, which is effectively a tax cut, not had a more fundamental impact on consumer confidence? Because I think people are still cautious. At the corporate level, it's even worse. So let's take what Paul just said about technological disruption. So you have two situations. One is you're facing what we've just touched on, a world that is growing slowly, that post-Lehman, with the exception of the snapback in 2010, which surprised, it was V-shaped recovery. 11, 12, 13, 14 has been slow and steady growth, with relatively no inflation, therefore very little pricing power, therefore firms very focused, particularly legacy firms, on cutting costs. So that's one thing. Second thing is, if you look at the spectrum in which you operate a legacy company, not a disruptor, at one end you have the disruption. You have Airbnb, you have Uber. Right. Using them as icons. At the other end, you have the 3G zero-based budgeters. I remind you that ABI now, the zero-based budgeting company, has a market cap of 200 billion. Its second string, Kraft Heinz, has a market cap of almost 100 billion. So we're talking about between the two in one sort of group, 300 billion. You have Coty buying 12.5 billion worth of assets from Procter & Gamble, Reckitt Benckiser, all of that. So that's the other end. In the middle, you have people like Paul, Dan Loeb, Bill Ackman, Nelson Peltz, who are putting pressure on companies for short-term performance.
The activists.
Yes.
They want
now,
change.
If you put those three things together, that's a pretty difficult cocktail for a CEO who on average lasts 5 to 6 years, a CFO who on average lasts 4 to 5 years, and a CMO, a Chief Marketing Officer, which obviously impacts our business particularly, who lasts 2 years. Hallelujah, that's up from 12 months ago when it was 18 months. In that world, I don't think, what do we see? As Zoomin said in the green room, we're not seeing capital investment. In fact, capital investment has come down recently.
And you're not seeing pricing power.
No
pricing power. Where is it?
So the standard firm, if there is one, at the micro level, is unwilling to commit and make investments. Ironically, paradoxically, it is those companies that are protected by what the corporate governance wonks don't like, i.e. concentration of voting power, that I think are the best models. So if I take a Rupert Murdoch, for example, I'm not saying that because we happen to be on a Fox Business program, but if I take a Rupert Murdoch, if I take a Roberts family, if I take a Zuckerberg at Facebook,
they have an ownership in the company, voting control.
A geared structure which offends corporate governance, one man, one vote, one woman, one vote, but which gives the management the ability to take long-term decisions. Fundamentally, we joined the long-term group, a McKinsey, Dow, Larry Fink, BlackRock. He's written, I think, to the chairman, CEOs of the S&P 500 twice, saying concentrate on the long term.
That's right.
So I think that's the fundamental thing that has to happen. Now, I think where Paul is absolutely bang on right is there are some fundamental things that you have to do to make corporates take a longer term view. Some of the things he mentioned about education, technology.
Well, they want to take a longer term view, but over the short term, they're not seeing the demand.
No.
I mean, there is a demand problem. Isn't that right?
Yes.
I don't believe so. I'd like to respond to two things, two themes that you just talked about. One is the post-2008 environment. It felt implicit in your comment that it almost didn't matter what the policy mix was, that people were cautious, they remained cautious, that impacted demand, that impacted the business climate. I don't actually believe that's true, that policy implicitly doesn't matter. I think better policies, more growth-supportive policies.
You're talking about fiscal policy. You're talking about tax reform and regulation.
Well,
which hasn't come.
Which hasn't come.
It's monetary policy that's driven it. I mean, how do you explain?
But I'm saying that it's the mix of policies post-2008, not just the spirit of
but
caution.
There's some fundamental things. How do you explain that companies are sitting on $7 trillion of net cash, at least, last time I looked at it, relatively unleveraged balance sheets? How do you explain the S&P 500 in 2014 paid back more in dividends and buybacks than it retained? In other words, it shrank. If you took S&P 500 as one firm, it shrank. It probably shrank also in 2015. So we've gone through 2 years where the biggest companies in the world have taken a view about the world economy which is limiting. and is not expansive. It has
Yeah.
implications for employment and everything.
One of the main
would say-
reasons why they're taking that view is that the policy landscape that they face, in two respects, supports those actions and that attitude. One is that the policy mix is not welcoming. Capital will go where it's welcome.
So what do we
Absolutely.
What do we have to get governments to do?
But I would
Stop
also-
raising taxes.
I would also put in
deal
here-
with regulation and make regulation rational. I'm not a deregulator.
This is a really good point because over the last 7 years, all we've had was central bank policy. And so we haven't seen the kind of fiscal policies that you're talking about, Paul. Ken.
But I'd also say the financial regulation that's come in also the general environment's made it very hard for small and medium-sized businesses around the world to invest. There are a lot of measures of monopoly power in major economies that's increased. And I think these companies are holding back from investment, trying to regain pricing power because they're not under pressure from the small and medium-sized businesses that might have been coming in and competing.
It gets even worse because the M&A activity that we saw last year, I think it was a record year. John, record year,
Yeah,
M&A?
Yeah, it's a record year.
So what was that activity? That was cost-based. We ran out of options, or they ran out of options to reduce costs, so let's get another cost base in to reduce costs. And by the way, the way we analyze M&A, how do you analyze M&A if you're a commentator?
I have a comment about the M&A story in a minute I want to share with you.
Yeah, I want to back to this investment issues. The $7 trillion, why they're sitting there, don't do anything. And Alan Greenspan showed me one of his chart, tell me today, the corporate cash investments to the cash ratio as lower as 1930. Mm-hmm. So why the corporate don't invest? I think that's the key question for the growth. We found today, globally, in terms of investment to GDP shares today, is below than 2007.
Exactly. And when you speak with bankers today, and this is the point that I wanted to make, we just had Jamie Dimon from JP Morgan on the program the other day, and one of the issues I see is much of the lending that we're seeing to corporates, the lending is going toward M&A.
Yeah.
The lending is not going toward CapEx increases for companies to spend in their business. I think that's a telltale sign.
Yeah, I think so. Set the policy framework to encourage the corporate sector to invest, provide the transparency and the certainty. I think the uncertainty is a big issue. If you ask the world, I think Martin, you ask 1,000 CEOs around the world, why do you don't invest? People will say number one is uncertainty. The uncertainty about the market, about the future, about the growth, about the tax policy, and about the financial market, because rates is so low, they expect rates going up. How far, how soon? So I think it's the key issue for the global policymaker in this world, ensure you have a clear policy framework, transparency, give the business section the certainty, and lead them to invest in the futures.
Right.
We see so many new technologies, innovations, pump out, as Paul just mentioned. There's a huge room for the investments. Infrastructure is needed everywhere.
Yeah.
Right?
I believe it's
so there's a
$3.6
big-
trillion needed in America alone.
Yeah.
Bridges and roads have deteriorated.
Martin, doesn't the interest rate landscape also encourage financial engineering, discourage bank lending? Bank lending margins are inherently challenged when interest rates are based on zero.
I agree with that, but it's because, Paul, there is a short-term philosophy. Now, let me just come back to M&A for a minute. How do you, as an investor, evaluate M&A in the companies in which you invest? You look at the cost synergies that they get, you tax them, you apply appropriate multiple, and if the resultant sum is greater than the premium, it's a great deal. If it's less than the premium, it's a lousy deal. If that company comes out with revenue synergies, they get laughed out, right? The interesting about SAB, Miller, and ABI, I remember, is if beer consumption in Africa rises to levels that we see in the Western world, that's a massive impact on the top line and profitability of SAB Miller. But those sort of things really get ignored. In fact, Lex, Breakingviews, and the others really laugh them out of court. It's a focus on cost, it's a focus on short term, and frankly, I think activist investors do have a responsibility. Activist investors tell us that they're long-term, not short-term. I don't think that's how they're perceived.
It depends on which activist investor you're talking about. Certainly some are more short-term than others. I mean,
Let's explore this for a moment because I think it's important and I think it's interesting. provocative, but interesting that one of the...
I'm deliberately trying to be provocative.
Thank you, and I thank you for that. It's interesting that one of the really good managers in the corporate world is raising this point. You don't have that many peers
At the moment,
around
can always
the world.
change.
But let's talk about it. Let's start with the concept of short-term and short-termism. A little-known fact, Elliott is among the firms you mentioned as activist investors. It's only a part of what we do. We're a multi-strategy fund. But our equity positions, our activist positions, our holding period over a long period of time, we've measured this over many episodes, is longer than the average institutional holding of common stocks. The average institutional holding of common stocks is a year and a half or something like that. And ours is longer.
And when you take an activist position, you're looking for change in how long?
Well, can I address that in a moment? But so the entire world has drifted towards shorter and shorter because this number, the institutional
Driven
holding
by
period,
the incentives that fund managers get, because the criticism of corporate incentives, they're not long-term enough. Institutional investor incentives
I agree with that.
Are too short-term based.
I agree with that.
But, whatever you say, the perception is the reality, the perception is that activists are short-term. So what I would recommend is a very high-level, mainly television corporate advertising campaign.
But I think
Get
what
the position right.
we appreciate the advice. We hope you don't charge for
I
it.
love that. That is your solution.
I think what Ju Min said
Ken Rogoff, go ahead.
What Ju Min said about uncertainty is a big driving force here. People are very nervous about what the long term is, and that's holding back investment also. I mean, and if you want to know why there's short-termism, it's because they're nervous about the long term.
Right. But Ken, let me ask you, we started earlier on China. Should the global markets be reacting so closely and immediately to the happenings in China? I mean, do you think it's warranted for us to be so worried about the growth story of China right now?
For emerging markets, absolutely. I mean, they're commodity exporters, not just oil exporters. This has been a big driving force. It's not all China. There's also just a cycle of investment. When metal prices are high, there's a big overinvestment. There are long lead and lag times. So there's still new production coming online in metals industries where they had no idea that
I mean, there's so much oil in the world now on the global market. Is there any reason to believe that oil should be at $100 a barrel anytime soon? I mean, now you've got Iran oil coming back on the market as well.
Listen, oil prices are so volatile. Never say never. I mean, these things, the investments just disappeared. And, if growth picks up, the prices are very sensitive to a couple million barrels. Last year when I was here, I was asked what the price of oil would be in a year, and I said, I don't know, it might be 20, it might be 100. And I think if you're looking at 2 or 3 years, you just don't know. And look at the oil price
When you say
history.
you just don't know, you do know something. I mean, we've got more oil than you thought on the market.
Now.
Would you say that now, in the next few years, oil should be where it is? Is it priced properly?
Oh, few years is a strong statement. 6 months, okay. But a few years you can get, who knows where the global economy will be, we can soak up those few million barrels, and there's no investment going on. It's just completely collapsed in the oil sector. So that'll come back.
But if I said to you,
On the oil sector, I think that we have to understand there's a fundamental structure change. Number one, the shale gas, shale oil become the swing producer. Because of technology, they can move in and move out. Their costs set the ceiling of oil costs. So I don't think the price will go back 100 quickly. It's not easy because this is a big amount of oil output now today. I think that's a big structure change. On the supply side, OPEC clearly lost monopoly power. So that's another issue. But they will not be able to set the ceiling of the price as they did. They only be able to set the bottom of the price. That means they compete to each other. They produce more, the price will on downside. If they can work together, they produce less, price can be up, high enough, the shale gas, shale oil move in, push the cost down.
Martin was
that's
talking
very
about,
important structure change.
But Martin was talking about oil as being a real positive for the consumer. And over the last year, I think it's been more of an indicator of where we are in the
You've got the
world.
counterbalance of the impact on the emerging markets or fast growth markets.
But there-
you have the Iranians coming into the oil supply situation as well. You have the Saudis unwilling to cut off oil and see the oil price and the impact on the economies. But just come back to, if I said to you, Maria, what was the price of oil per barrel when John Brown at BP bought Amoco and Arco in 2001?
2001, I want to say $10.
It's exactly right, $10 and $11, and we're complaining about a $20 price. So
Yeah, I
it has been
remember,
highly
yeah.
volatile. But if you look at it from a micro point of view, from a CEO's point of view, you come to Davos. What do you? I just jotted down before we started what are the major sort of risks that we and our company see. So China, oil, Saudi Arabia, migration in Europe and elsewhere, US political situation, Brexit, cyber. I mean, you put that little lot together, what is anybody going to do when they're looking at their budgets for 2016 or beyond? They're going to be very conservative. So I don't think this is a particularly gloomy scenario, but the new normal is a low-growth world where inflation is probably under too much control, because we'd like a little bit of inflation to get some pricing power for our clients and also to get something into the wage system. But I think that's the scenario that will continue.
This is the new normal, low growth.
This is the new normal, low growth. Because by definition, the system couldn't sustain pre-Lehman growth rates because it blew up.
By the end of this panel, I certainly want to find out where the growth stories are. I recognize this is a new normal. We're talking about a low growth story, but we all want to find out where the bright spots are. But Min, you wanted to jump in.
Yeah, you also raised a very interesting good question about the low oil price and why it did not push for the consumption. Because there's also a structure change. When we say oil price drop, we always say it's just a redistribution of the wealth, right, from export to the import. And before 10, 15 years ago, the export have very lower consumption elasticities. They save 3/4 of their profit into the overseas investments. So stimulating for the consumption is limited. When you move to the import side, if oil price is lower, every penny they get is a rainfall, right? They consume. Today, it's complete change. Because oil export country use up to more than 90% of their profit to consume. So the consumption elasticity against oil price is way, way high. And in advanced economy, consumer elasticity against oil price is much lower. So that's what we see in United States, the consumers' household saving rates increase rather than decrease. They save part of their income from the low oil price rather than spend all of this to the other grocery shoppings.
Yeah.
I mean, this is a big consumer behavior change, also reflect in a certain way
Why do you think
the uncertainty.
Do you think that's because of 2008 or forever?
Yeah, because the balance is repairing and uncertainty. And also people understand that you're going to live longer, you need more money for the future.
I'd like to frame it a little bit differently, but I agree with what you said about the consumer. In the United States, a tremendous amount of infrastructure, not just direct infrastructure of oil exploration, but infrastructure surrounding it, had been built up based upon certain expectations of price and profitability. Therefore, there was a balance when oil prices collapsed, but I felt and feel that the benefit to consumers is diffuse and turns out to have gone more into savings. But the detriment to those places, companies, places, debt, capital structures that relied upon the continuation of medium to high prices was very direct and very impactful, as well, of course, being very impactful on emerging markets and places that export for oil. There's one more part of the oil equation that's worth putting into the mix, and that's the geopolitical on the supply side. Iran is coming into the mix. Saudi Arabia has challenges to its political stability, and other places that drill and export oil are under various potential geopolitical challenges. And I think those things are not necessarily long-term impacts on the oil markets, but they certainly could cause disruptions and volatility.
This is a really important point, and I wonder if you all believe that part of the uncertainty and worry out there is what's happening in the Middle East. I mean, this most recent upset between the Saudis and Iran, and some other countries following Saudi Arabia's lead in cutting ties with Iran. Is this also an underpinning to the uncertainty out there, the fact that we're seeing the Middle East issues worsen?
I mean, I want to say yes, but at the same time, historically, that's usually translated into will the oil price go up? And if the oil price goes up, that's going to cause a problem.
Okay.
So,
but,
I mean,
on the central bank question, can the Federal Reserve in the U.S. raise interest rates in 2016 when all of its colleagues around the world, Japan, Europe, are lowering interest rates?
Well, it depends on where the U.S. economy is going. So if U.S. labor markets continue to tighten and the U.S. domestic demand continues to be strong, it certainly can. I mean, if this continues, then obviously they won't. They'll be looking to go into reverse. But on the other hand, I mean, I'm not sure that it will. I mean, I bet they do raise interest rates further. I don't think that's a decisive factor in what's going on.
The strong dollar has put pressure on U.S. multinational profits, and that's caused more of a trigger on this issue of cost control. And if I look at the 16 budgets, when you look at the strength of the U.S. dollar, that's causing more pressure in the system to cut costs.
It certainly hits the stock prices and U.S. profits. It doesn't necessarily translate quickly into employment because everything's priced in dollars, and the short-run impact there is not as large.
Just come back to the question you raised. I mean, if an economy is growing at 3 or 4, whatever it is, that means that certain sectors can grow at sort of 6 or 8, and some can go at 0. Some can be at negative, some can be at higher positive rates. Now, just take the automotive industry, which is key. And I just went to CES, and I went to the Detroit Auto Show.
A lot of technology now in the auto business.
Well, you see more technology at CES on auto than you do in Detroit, which is interesting in and of itself because it tells you a little bit about the disruptive technology. But if you're running an automotive company, what do you face? Singapore has an RFP out for a driverless car zone, which, as far as I know, Google are bidding for, GM is bidding for, and Continental are bidding for. Oslo has announced it will have a car-free zone by 2019. I think another city is already triggered.
This is really interesting.
Most mayors will do this. Milan is in the midst of a car-sharing experiment. It's reduced the sales of autos by 10%. So if you're running an automotive company, which is a legacy company, you have to switch. And by the way, another thing, 3D printing. I saw a 2-seater sports car, full size, which was 3D printed with the exception of seats and tires.
Are you kidding me?
No, absolutely true. Unfortunately, it was on CNBC, Sport Box, but it was. So it can't be true. No, so we saw it. I didn't see it working, but I saw it.
That is fascinating.
So what does this mean for somebody who's running? And so you have to make some big bets.
Yeah.
Unless you're insulated, you take Ford, which is our largest client, it is insulated.
Well, it's also doing driverless. It's trying to do its own driverless.
It can make the investments that it needs to make.
I agree. There's a massive attack on the global auto business right now. How many people in the audience would put their family in a driverless car? How many people would not put their family in a driverless car? It's interesting. More people would not. But the truth is with a driverless car, you don't have to worry that the driver is texting. You don't have to worry that the driver didn't get enough sleep, had alcohol last night, and the driver knows everything, or the driverless car knows everything around them. Although I think I might be with the people who are not going to put the family in a driver. I don't know why, but it's interesting when you look at disruption.
Yeah, but the point is that people who, and most of the businesses we're talking about that have an impact on employment are legacy businesses. I'm using that word. That's a bad word to use, but they're rooted in older technologies. The disruption causes tremendous disruption to long-term thinking too, unless you're insulated. And I think it's really interesting that the companies that we deal with, are the insulated, that do well, I think are the insulated companies.
Well, go ahead, Ben.
Yeah, on the technology side, I mean, Paul and Martin, mentioned all this new. Everybody see so many new innovations in the product pump out. But the mystery is the key issues. We see productivity is still on downward trends, right? So it's only two answers for that. Number one, that's a measurement issue. Right? So they are not properly measured into the GDP growth or whatever. And I think that's possible. We still don't know how to measure those issues. But clearly, another issue is those technologies haven't been industrialized. I think that's very important. We haven't seen the things that bring all the technology together. I mean, the driverless car could be one, but until it's industry and commercially in the scale, it's not there.
See, I think healthcare, the disruption going on in healthcare, and the fact that we have such longevity now is really one of the growth stories. We have to get the growth stories where you all believe there is growth and will be growth in the global economy. And I also want to get to the issue of liquidity, Paul, which you mentioned to me earlier. But first, let's get some interaction from the audience. Question for our first-class panel right here. We have microphones walking around, and we would love to hear, yes, sir, right here in the front. And John Studinsky as well.
Thank you. The subject of this panel is preventing future shocks. We have talked a lot about the past and the present, but I would like to hear what should we do fundamentally to prevent future shocks?
Thank you for that very important question. Paul.
I think the most significant thing that can be done to prevent future shocks that are preventable is deleveraging the financial system. Over a period of 40 years or so, the major financial institutions in the world have evolved from being banks to basically being banks and investment banks together with the largest and most leveraged trading firms on the planet through the use of derivatives. Each one of the major financial institutions has a balance sheet that looks something like $150 to $200 billion of capital, equity and preferred, $2 to $3 trillion of assets, balance sheet assets, and at present, $40 to $80 trillion notional amount of derivatives. It's still opaque, it's still highly leveraged. These derivatives are largely, although notional amounts are not the proper measure of risk, among those trillions are the effective equivalent of balance sheet assets, but you can't figure it out from disclosures. And so there's no reason, in my view, why major financial institutions shouldn't be margined like customers so that they are sound. If they were sounder, and I disagree with Sir Martin in the way he framed the growth up to 2008 and then the growth subsequent to 2008. It wasn't that the economy crashed or the global system crashed because it couldn't grow at those rates. It was that it was over-leveraged and very vulnerable in a way that policymakers, financial institution heads, as well as investors didn't understand. And so deleveraging the financial system would go a long way towards, and is the single biggest element.
Now, we've seen a lot of deleveraging
de-risking
this year, by the way. So you're saying deleverage if you're a corporation, individual, government, just continue the deleveraging.
I'm talking about the financial system,
Just
the
the financial
institutions, and it has come down. But if you look at 1970 or 1980, 2007, and today. So today, the leverage is lower than in 2007. Mm-hmm. But 2007 was insane. And today, compared to when banks were sound and weren't primarily trading vehicles.
That's good.
I would argue,
preventing future shocks.
I would argue that the leverage increased the growth rate. The corporate sector is probably deleveraged to a very significant degree, and to some extent,
You've got a lot of capital at this point.
A lot of over. In fact, it's the opposite with the corporate sector. I think the corporate sector has to be encouraged to take risk.
Yeah, I think the deleverage is important, but it's not enough. I mean, it's
what else? How else do you prevent future shocks?
The key challenge for your question, we're suffering in the past, we're going to continue to face in the future, we still don't fully understand is the global interconnectivity and the spillover. We live such close interconnected world, and every small activities, events will spill over across the whole financial market. The financial market co-movements across different classes of assets increased dramatically. Before crisis, the market co-movements from the emerging market equity, advance, and the bonds, equity, whatever, high yields, 20%. During the crisis, 80%. Today, around 50 to 60. And anytime market volatiles, go back to 80%. If a market move in the same direction, 80% correlation, how do you prevent the crisis? I think that's the real challenge. In the past 12 months, we observe the largest volatility. For example, in the US equity market, 4 times the deviation one day against the 100-day averaging since 1932. In the bonds market, 6 times deviation, standard deviation widened against the 100 days moving average since 1970s. Last year, we observed so many volatilities break the records in the history because it's co-movements and interconnectivities.
But
further, let me add this further, even worse. What we documented, we found when the market moved together, the real scary thing is the liquidity surged dramatically. Theoretically, you can think about that. If everybody moving together, want to sell, want to buy, want to move things, you don't have liquidity at all.
Yeah, the liquidity.
What we observe is a really key issue when it's close, so close associated with co-movements increase upside, the liquidity drop immediately. So then the key issue is when market have uncertainty, have unanticipated events that happen, rip out the whole world systems, the spillover, and the market volatiles, and the liquidity surge dramatically, which scares everyone.
Yeah, and I want to get
in
Paul,
that sense,
your take on liquidity later.
Policy, I think it's very important. For the macro level, I think clearly for the policymaker today, regulators, you have to understand the situation. You have to be ready to act very fast, very fast.
Very important.
And also for the corporate sector, you got to understand this huge volatility, but short-term volatility. It's not a meltdown, let me emphasize again. It's a huge volatility, but short. You got to have enough buffer to prepare. It's a huge shock, but short.
Know what you're dealing with, get in front of it.
Yeah,
Ken, your thoughts on preventing future shocks?
Yeah, but I think the sensitivity is a reflection of the over-leveraging that Paul was talking about. And in a lot of countries in Europe, the leverage has not come down very much. We have a lot of zombie banks. China has been leveraging up like crazy. The United States has sort of had microscopic deleveraging in some sectors.
You're talking about the financial sector.
Yeah. Well, the financial sector is deleveraged more. No, I think the way forward in the financial sector is to require much greater equity for banks and to have new financial instruments that are less sensitive to bank runs and such. So, I think really what we're talking about with policy, you can't stop countries from having frictions, wars, migration problems, productivity shocks. You can try to not amplify them when they come. I think that's really what you can work on. Of course, we'd like to guess what global warming is going to be and what trends are going to be, but we have a system that amplifies shocks, and certainly the global connectivity is very important, although I think a part of this is the leverage, and then that's making when the central banks move a little, everybody jumps.
Right, and I think what you said earlier in terms of fiscal policy was very important. Do you feel that...
Nothing on the geopolitical front. There is nothing to be done on the geopolitical front to prevent future shocks.
What do you think should be done, sir?
No, this is a question for Martin.
No, it's not. Far be it from me. That's more for you than it is for me.
Well, it's an important question because that really has been where the uncertainty has been. Putting markets aside, global uncertainty.
Yeah, in fact,
geopolitical issues.
We're missing a good global coordination.
Yeah.
And I think that there is much more to be done from our leaders, our political leaders, mostly in the Western world, but certainly with the newcomers, into better coordination.
Yeah.
Because the lack of coordination has created, as a consequence, a lot of these problems that we are observing. And coordination means negotiation. And negotiation means, well, give and take. But I think that if we take a long-term view to the problems and we act in a coordinated way, we have to accept in short term some adjustments, but we have at least a direction where to move, and our leaders are responsible for achieving
Yeah.
that.
Thank you, sir.
Yeah.
We have two questions here, John Sudinsky and Lucky Izawa from Japan. Go ahead, sir.
Maria, thank you for organizing and orchestrating a very feisty discussion here this morning. Preventing future shocks, I'm going to take Carlos's word of leadership. The elephant in the room, from my perspective, is leadership. The activist community, Paul, you've talked about it. Activists generally go after situations where they feel there's a dearth of leadership or direction. Martin talking about M&A and strategy. Companies need leadership. Min talking about capital expenditures. A lot of that, the perception now among shareholders is chief executives lack a sense of direction and leadership. In the future, what are the 2 or 3 ingredients required or characteristics required for the real, true leaders of the future? Because there is a theory that a lot of the uncertainty right now in the markets, a lot of the turbulence is just a pure reaction to a perceived lack of leadership, certainly in the corporate sector, in the government sector.
Thoughts on leadership, gentlemen?
Well, you moderated the presidential debate, so what do you think?
Well,
Yes, I did. Yeah, and I think that during that debate, we were able to draw out some ideas in terms of fiscal policy, like tax policy, like immigration. And these are the fundamental issues for the people, as well as the geopolitical story. There are a number of leaders, I think, who are up for the job. We'll see what the people believe.
You know, coming to John's point, but the corporate sector
asset
mirrors
allocation.
the corporate sector. I think, John, mirrors what you see politically. I mean, let's take the UK for a minute. We have a fixed 5-year election now. I get the feeling, this is not a criticism, I think it's just a political fact, that the government Conservatives with a clear majority, that the Chancellor, who's now the COO of the government, he's no longer the CFO, he's more than and potentially the CEO, is thinking about what happens in 2020. So we will see the UK economy be, it will do well, I think, but it will not be as robust as it's been in the last few years, gearing up for an election in 2020. In other words, we get into these cycles, and they can be 4 years, 5 years, 6 years, depending on what the political cycle is. In the corporate area, I think, we've been at it at WPP for 30 years, right? Some people say that's too long. But I think it has enabled us to think about the long term. So when Maria says, where's the growth? Despite all that's happening, despite the new normal, right, which I think is the thing, where do we see the growth? There's growth in the fast-growing markets. We look 25 years hence, the BRICS and the next 11 is still a concept that we think is fundamental.
So you still think that the emerging markets will be the leaders in terms of growth?
Don't call them emerging, it's insulting. China is the second largest economy in the world. It's emerged,
Okay.
right? It's a fast-growing market
saying, yeah.
that has slowed down, but it's still fast-growing. If you believe the 6.9, it's still fast-growing. It's a $10, $11 trillion market, even if it's growing at 4. The delta is greater than the US economy this year. So BRICS and next 11, I'm still pinning the hopes of WPP for the next 30 years on that. Digital is 40% of our business. We're still pinning our hopes on that. Data, still. So there are growth sectors, because even if the economy, as I said, is growing at 3 or 4%, there are fast growth sectors. You have to avoid the slow growth. So there's still, but I think to John's point, the leadership has to come around long-term vision. And so I really applaud the efforts that are being made in the corporate sector, which is where we interact most of our time, not all of our time, but most of the time, in the corporate sector, to set a vision, to stick to it, and not be subject to the vagaries of short-termism, which I think is the fundamental problem that we face in the corporate sector.
Okay, thank you for identifying growth stories. Go ahead, Paul.
I think John's question is a very important question. I have 2 comments on 2 aspects of it. It's not a comprehensive comment on leadership in corporations, but 2 things that affect it. Structural. When, for example, financial institutions migrated several decades ago from privately owned to publicly traded, I think a very important change in incentives, disincentives, attention to risk, stewardship, culture were thrown into the garbage can, and in a very harmful way, which I believe had a denouement in the fall of 2008. Also structural in terms of corporate governance, and I'll focus on America for this one. The idea, real briefly, the idea in America is that shareholders in a public, and it's brought America a great amount of prosperity, but I believe it's deeply damaged at this point. Shareholders elect a board of directors which sets strategy and hires the management and has supervision of the management. I think that model is broken. I think in a lot of cases, management selects the board of directors. In a lot of cases, I recommend to everyone looking at the composition of the boards of directors of every major global financial institution in the summer of 2008. It could be 2007, 6, and it could be today, actually. But
look at your board.
Look at the board and see what proportion of board members are actually experts in the particular business, understanding the particular industry or sub-industry or subsector.
And that will exhibit leadership to you.
Versus luminaries, et cetera. The leadership point is that the leaders that are selected by a process that they're not selected, they select the boards and they're entrenched, and the institutional community just reflexively supports them, which is evolving and changing.
Yeah,
But
this is a very good point, yeah, Paul.
In that world, you get leaders, you get some great leaders, you get some very ordinary leaders, and you get some people that shareholders and stakeholders, because debt holders are also.
How would you alter the structure?
I'd actually, that's a great question. I'd actually address it in the United States legislatively and by rules concerning
Separating
elections.
chairman and CEOs?
I don't think that's such an impactful.
But make sure that people on the board have a clear understanding of the business, where it's going, not just that they have a relationship with the CEO.
I think that's something that could be self-selected, but yes, that
Very
would be.
important.
I don't have a
We have
blueprint
about
here
5
today.
minutes left. I certainly want to get Min and Ken and Paul, your ideas in terms of where growth is, but we want to hear from Lucky Izawa right now from Japan. Real quick, Lucky.
I'm Lucky Izawa, BlackRock Japan CEO.
BlackRock Japan.
Yeah, I changed. Thank you very much for the very interesting discussion. It's the last 3 weeks, world is turbulence. It's especially Japan. It's the stock price market is terrible, but we have to think about the more and more longer term vision. I am on the base of the long term view. He asked the question, the leader's role of the for longer term vision. Mr. Singer replied, very good answer. The corporate governance or stewardship is very important for future. The preventing the future risk is each corporation and make it healthy and sustainable growth. It's very important. And I think 4 things I asked we ask each top management in the world. One is capital investment more. And the second one, the R&D investment more. Third one is the human resource investment to the human resource. And fourth, depending on the company, a wage up. This is on the base of the top management leader, what should do. Generally speaking, Japan, the US, and Europe, the large companies are mostly sitting on the cash.
Right. So when are we going to see that cash move and do those kinds of things that you're talking about? Investing in CapEx, investing in R&D.
That's something I like to ask them.
Seeing wages move higher.
Yeah, let me make 2 points quickly, sort of response to your question. The first issue is gentleman's point, the geopolitical crisis crisis and the risk. I would say this year, the political risk is the key risk. We still have a growth, 3.4.
Right.
It's not as strong as we thought, but still 3.4. We had a market volatility turmoil, but market still there's not meltdown, as I disagree with you. But I think the political risk today is really the key risk, which implies we're facing a lot of uncertainties and a lot of shocks. I think that's we need to keep in mind, because those things is hard to predict, hard to understand, but things link to each other. I think that's the key issue, is really, if we're looking to prevent for the future shocks, that's the key area, although we don't know how. But I think we have to.
And you just dinged
Yeah.
capital investment budgets of most major private corporations, the corporate sector, by introducing further risk.
No. The second issue is response to your question, where the growth comes from. I would say globally, growth comes from structural reform.
Structural reform.
Because clearly, we don't have aggregate demand, right? We don't have a fiscal policy space. We don't have a monetary policy space. Interest rates are zero already.
That takes me back to what Paul said, and that is
So
things
the
like
only-
tax reform.
But there's huge room for the structural reform, the product market reform, labor market reform, and the pension reform, tax reform. I think that's the huge area for the potential growth for the whole world. All the politicians, policymakers should put emphasis in this area to promote the growth for today and for tomorrow.
Okay, so we need structural reform for growth, and that's where you're finding it. Ken Rogoff, where is the growth in the world, and where will it be?
Well, reinforcing this point, if you don't have good institutions, if you don't have good governance, if you don't have good leadership, nothing's going to help. You can have all the technology in the world, you're not going to get growth. We do have a lot of technology. Fourth industrial revolution, I don't know, but a lot of things. A lot of it's frozen up because there's not investment. We've gone through what I call a debt super cycle. China's the last leg of it. We're still emerging. But I think in the long run, if you get these things straight, you don't have to get everything straight, just something straight, some improvements. It's been pretty lame the last few years. Then I think we can see growth, artificial intelligence, the medical sector, et cetera.
So exactly, there are growth stories in the world. Final moment here. You mentioned liquidity is an issue, Paul Singer. Touch on that and give me your recommendation for growth.
I think liquidity and the changes in the liquidity posture of markets is a kind of an overlay to everything that we've been saying on this panel. And I think there's no question that it's diminished, and the prospects are that if what's happening in the last couple of weeks turns into something significant, it's not yet, I agree, it's not yet a meltdown, but something significant, some of the moves of the last few years have given some indication that at some point things could be very disorderly. The August 24th episode, several flash crashes. Bank liquidity has been sharply impacted. Anyone here who's a banker knows the constant regulatory pressures to reduce positions, to fire customers, in effect. A lot of my peers have been ejected from prime brokerage.
Hedge fund closures.
Yes.
It sounds like you're expecting things to get worse before they get better.
I'm saying that if they get worse, the liquidity posture of markets, a combination of banks lowering liquidity, this new force of sovereign wealth funds, very few people are thinking about that as a liquidity
There are
element.
also commodity companies that are under tremendous pressure.
Sure.
We're going to see probably, talking to some hedge funds last night, some bankruptcies, Chapter 11s in commodity sector.
Because of the commodities breakdown.
Energy.
One more element?
Yes.
One more element. I think very few people have focused on this. To the extent that securities prices, stocks and bonds, particularly bonds around the world, are distorted in price by central bank buying, there's a potential for a tectonic shift if holders of those securities decide that they've lost confidence in central bankers for any one of a host of reasons. So liquidity is a concern of mine going forward. I couldn't put it any better than Ken in terms of global growth. We've discussed the elements, leadership and governance, et cetera, policy.
I think Martin and Min, you are a bit more positive.
Well, there is growth there. I mean, the corporate sector Corporate profits as a proportion of GNP at all-time high?
Yeah.
Yeah. Labor, actually, as a proportion of GNP all-time low.
No, that's low. Yeah, that's the issue.
So that's the balance issue.
This has been a very smart discussion, and I appreciate it. Thanks very much, Ken Rogoff, Zhu Min, Martin Sorrell, and Paul Singer. Ladies and gentlemen, thank you.